This has been a rough week for tech stocks, especially those with rich valuations and those with profitless income statements. Why is this sell-off happening? What does it mean for you? And what does it mean for the future of the market? Let's go. What's up, you guys? Steven here. When I saw this, I thought it would be a valuable addition to the videos that I've been creating recently. This move happened exactly because of what we've been talking about. So I figured I should get this message out to you all, that it would be helpful to reinforce those lessons that we've been learning and reviewing over this last month. Now, if you watch the markets closely, which I honestly do not advise, that is generally not a helpful practice, but if you have been keeping tabs on the market over this last week, you've probably noticed the carnage in the tech space. The black line here is the NASDAQ 100, an index, as you probably know, made of the 100 largest non-financial companies listed on the NASDAQ stock exchange. It's the most tech-heavy of the mainstream indices. You can see the sell-off over this last week, but of course, when considered with the overarching trend line here, this move is not too out of the ordinary. It's the underlying stocks driving this bigger move that's more interesting. The blue line representing tech companies with high-flying valuations, and the red line representing those with no profits. So here's what's happening. Hedge funds are dramatically reducing their exposure to tech stocks, especially, as you can see, those with relatively expensive valuations and those that are unprofitable, which, if you remember, were kind of all the rage early on last year. At the end of last year, though, selling in these areas was happening, except on the short side. That is to say, those hedge funds that take on short positions to bet against the future performance of a stock, they were the ones selling as a profit-seeking investment or trade at the end of last year. Nothing too out of the ordinary there either. They put on those bets in anticipation of what I talked about in this video. In there, we talked about which kind of stocks would perform best during periods of high inflation, growth, value, or income. And yeah, growth is the loser of that bunch. Value actually does much better during periods of inflation. That's because growth stocks often need infusions of capital to keep going, to keep growing. And when inflation is starting to rise, as we discussed in this video, one of the best ways for the government to combat it is by letting interest rates go up. In other words, making it more expensive to have access to that next capital infusion. And when you increase expenses, especially on already not profitable companies, it makes their potential success story that much less likely. So as a way to play this inflation narrative, savvy investors and funds sold short these overvalued tech companies. Okay, so that brings us to the end of the year, but that's not what's happening today. You see, at the beginning of this year, for the first several trading days, hedge funds sold more tech stocks than ever before on a dollar basis, and since Goldman Sachs has been tracking these data over the last decade. But this time, Goldman says the sales were primarily driven by long selling. That is, funds that have had long positions in these stocks, a bet on an upward movement. They just owned shares outright in these companies in anticipation of the price of the stock going up. Well, they're now unwinding those positions because they don't like how the future looks for these high growth tech stocks, not as much as they did before. So what is it exactly that they don't like about the future that's causing an unprecedented, more than ever before, value of shares to be sold? Well, it's the fear of what the Fed might do to at least attempt to make the necessary course correction that we talked about here. When they released the minutes from their most recent meeting earlier this week, it became clear that not only are they talking about tapering bond purchases and increasing interest rates, but they're also discussing the need to reduce their balance sheet. That last part probably warrants a whole explainer video by itself. It can get stupid confusing. If you're interested, let me know in the comments. But in short, the Fed is still adding money to the money supply every month. Rates are touching 0%, and its balance sheet is higher than it's ever been before, a natural consequence of leaving on the money printing spigot. So what options does the Fed have? They could stop their monthly bond purchases, which would stop flooding the system with a continuous supply of new money. They could increase the Fed funds rate, which would allow interest rates everywhere to increase. And then to reduce their balance sheet, they could sell securities that they own, which would be very aggressive, not likely to happen. Or, more likely, just stop reinvesting when the bonds they own mature. All of these put downward pressure on the economy, and downward economic pressure makes it more challenging for a growth stock to thrive. Of course, that's just one of innumerable factors for an individual stock's success, but that's the one that everyone is paying attention to right now en masse for the reasons I've outlined in recent videos. What's crazy to me, and mildly humorous, to think about is how sensitive the market is to this. The recent move, the hedge funds selling more of their long tech positions than ever before, that move was just in anticipation of what the Fed was going to say that they had talked about maybe doing at some point in the future, right? The sell-off really started before the Fed minutes were even released earlier this week. Isn't that just a little bit ridiculous?
Ridiculous!
And then, due to the fact that they admitted what most of these savvy traders, investors, and fund managers know needs to happen anyway, but it's because they outwardly admitted that they need to do all of these things that I just outlined, the market continued to fall, fell even more. So what does this all mean for you? How should it affect you? Should you join in the selling? This is indicative of the volatility for which you should at least be prepared. Well, even more, actually. Every time any member of the Fed says anything, the markets are going to react. But if this was the reaction to them talking about probably maybe doing something in a few months, once the thing is actually done, the move will likely be even more dramatic. That shouldn't really affect you if you truly understand in what it is that you've invested. If you've performed a thorough analysis, you know the company can withstand these types of very real risks, and your time horizon is appropriate, you should be fine. But be prepared for these types of, and even more, chaotic movements. It's kind of just the way things are now with how fast and connected everything is these days. If, on the other hand, you have some speculative positions that you're just kind of hoping will play out, or you just own something because someone else who sounds like they know what they're talking about said that they owned it, or you've just generally been growth stock heavy, but you have a shorter timeline or a lower threshold for downside volatility, then yeah, you probably should spend a little time reflecting on your life choices, at least your investment choices. So that's how this affects your individual holdings. But what about the market as a whole? If the Fed were to continue down the path that I believe they should, stopping their purchases, allowing rates to rise, and allowing their bonds to mature, thus reducing their balance sheet, the market would freak out.
Everybody panic!
I believe in the long run that would put us in a much better position, but that's not how the Fed tends to operate. When the market is selling off due to things they're saying or doing, no matter whether they're the things that need to be done, the Fed has a history of accommodating, of trying to make the markets happy. In other words, you should be ready for volatility. But I don't think that will all necessarily be on the downside. I think once the Fed has seen enough on the downside, they'll back off and even start to go the other way if it's too dramatic, like they always do. That is, I think that's what they'll do until they can't anymore, which was kind of the whole thesis of this video. So you really should watch this one next to understand how we've kind of created a catch-22 for ourselves here. I don't see a non-financial crisis way out of this. So watch this one and let me know what you think. I'll see you over there. Good luck out there. Take care.